Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets buried within corporate filings. Today we're diving into a deal that sounds like a significant shift for ATN International Incorporated. A move that could reshape their infrastructure business. ATN International Incorporated is filing a Form 8K, which is a current report used to announce major events that shareholders should know about. Think of it as the company's way of quickly sharing important news that could affect its stock value. In this specific filing, the big news revolves around a massive sale of their tower portfolio. So, who is ATN International Incorporated? They're involved in telecommunication infrastructure, essentially owning and operating wireless towers and other related assets. You've probably seen those tall structures scattered across the landscape, and ATN is one of the companies behind them. This filing details a plan to sell off a huge chunk of these assets. The core of this report is a purchase and sale agreement, a fancy term for a contract outlining the terms of selling something. In this case, it is about selling a significant portion of ATN's tower sites. We're talking about land, the towers themselves, and the operations tied to them. The buyer in this deal is Everest Infrastructure Partners Incorporated, an affiliate of a company focused on acquiring and managing infrastructure assets, particularly in the telecommunications realm. This acquisition by Everest signals a consolidation in the tower industry, with larger players often buying up assets to achieve economies of scale. So what exactly is being sold? ATN, through several of its subsidiaries like Comnet Wireless LLC, is selling about 214 tower sites. This represents a major part of their tower business, meaning a big shift in their operational footprint. Imagine a company selling off a significant number of its stores or factories. That is the scale of this transaction for ATN. And for this substantial portfolio, ATN is set to receive up to $297 million in cash. This is a game changer for any company. This cash infusion can be used for various purposes like paying down debt, investing in new ventures, or returning value to shareholders. The up to part is important because the final amount can be adjusted based on certain finalization details outlined in the agreement. The deal is structured in a way that ATN will transfer these tower sites into a newly formed company, a subsidiary that Everest will then acquire. This is a common method for complex asset transfers, allowing for cleaner separation and management of the assets post-acquisition. It is like packing all the items into a specific box before selling the whole box. This sale isn't necessarily a single event. The agreement allows for multiple closings. This means ATN might hand over some towers, now with others to follow later as certain conditions are met. This phased approach can help manage the transition smoothly for both sides and ensure all regulatory and operational hurdles are cleared one by one. The towers are categorized into assigned sites, managed sites, and deferred sites, which essentially means some are ready to go, some Everest will manage during the transition, and others have conditions that need to be met before they can be fully transferred. At the first closing, ATN will transfer the truly ready to go tower sites to the new company, and Everest will buy that company. Everest will then pay the cash for these sites, and also for those they will manage. This is where the management agreement comes into play, with Everest taking over the reins of those sites even before the official transfer of ownership. Following the sale, ATN isn't just walking away completely. They are entering into several agreements that keep them involved. For instance, there are master lease agreements. This means ATN will lease back space on some of the towers they just sold, allowing them to continue using the infrastructure for their own operations. They're also entering a preferred backhaul agreement, meaning ATN will be the preferred provider for networking services for these towers. This shows a strategy of divesting physical assets while retaining operational capabilities and revenue streams. The timeline for this big transaction is the second quarter of 2026. This gives both parties a good amount of time to iron out all the details and satisfy any remaining conditions. This also means ATN will be operating with this pending sale for a little while longer. Now, what happens if this deal falls apart? The agreement includes a termination fee. If Everest backs out for non-fault reasons, they'll have to pay ATN about $14.9 million. This acts as a form of protection for ATN, compensating them for the time and effort invested in the deal should it not go through. Beyond the direct sale agreement, there is also a consent agreement. This is crucial because ATN has existing debt. They need permission from their lenders to go through with this sale and to use the cash proceeds in a specific way. The consent comes from CoBank, which seems to be a major lender. They've agreed to the transaction and how the money will be used. This consent is vital because it ensures ATN can legally use the proceeds from the sale to manage its financial obligations, like paying off loans and for general company needs. A key part of this consent is the release of liens. When you borrow money, the lender often places a lien on your assets as security. This means they have a claim on those assets. With this consent, those claims on the towers being sold are released. clearing the way for a clean transfer to Everest. This section of the filing is largely informational, incorporating details from the previous item. It essentially flags any new significant financial commitments or arrangements the company is entering into. In this case, it's tied to the massive tower sale and the related agreements, like the leaseback arrangements. This item deals with Regulation Fair Disclosure, or Reg FD. This rule ensures that when a company releases material non-public information, it does so publicly, not just to a select few. ATN has issued a press release to announce this transaction, and that press release is also filed with the CT as part of this report. And here it is, Exhibit 99.1, the press release. This is where the company's official statement about the deal is found, providing a summary of the transaction for the public and investors. It is often written to highlight the positive aspects of the deal. Alright, let's talk numbers and strategy. ATN International is selling a significant portion of its tower assets for potentially $297 million. This is a strategic move. ATN is shifting from being a heavy owner of physical tower infrastructure to potentially a more focused player in network services and perhaps a smaller, more curated portfolio of owned assets. Think of it this way, owning 214 tower sites is capital intensive. It requires constant investment in maintenance, upgrades, and securing new tenants. By selling these, ATN frees up a substantial amount of cash. This $297 million is a huge sum. If a company has, say, $300 million in debt, this sale effectively clears most of it. It strengthens their balance sheet considerably. What is interesting about this deal is the leaseback. ATN isn't completely cutting ties, they're leasing back space on the towers they sold. This means even though Everest owns the physical asset, ATN continues to operate its wireless services from those locations. This is a smart way to monetize infrastructure while maintaining essential operational capabilities. It's like selling your house but signing a long-term lease to keep living in it and running your business from there. This strategy is often employed by companies looking to unlock capital tied up in real estate or fixed assets without disrupting their core operations. The fact that ATN is also becoming the preferred backhaul provider for Everest on these sites is another layer of revenue generation. Backhaul refers to the connection between the cell tower and the rest of the network. By securing this role, ATN ensures it continues to profit from the services that run over these towers. This sale aligns with a broader trend in the telecommunications industry. Many companies are divesting their tower assets to specialized tower companies like Everest, which can manage these assets more efficiently and at a larger scale. This allows the original telecom operators like ATN to focus on their core services, like providing wireless coverage and managing customer relationships. The biggest risk here would be if the leaseback agreements aren't managed efficiently or if the terms become unfavorable over time. ATN has essentially outsourced the ownership and management of a significant piece of its operational infrastructure. While they retain control of their services, they are now dependent on Everest for the physical infrastructure itself. ATN's direction here seems clear: reduce debt, generate significant cash, and refocus on their service-oriented business. The $297 million is key. If they use it wisely, paying down debt and investing in growth areas rather than just keeping it as cash, this could be a very strong move for the company. The market will be watching how they deploy this capital and how effectively they manage the ongoing relationship with Everest. Alright, that is our breakdown of ATN International's Form 8. Okay, what is your take on this massive tower sale and its implications for the company? Do you think this is a smart strategic move or a sign of ATN shedding core assets? Drop your thoughts in the comments below. If this analysis was helpful, please hit that like button and subscribe for more deep dives into the corporate world. Also, join our Discord community linked in the description, where we discuss these filings and more. Thanks for watching, and we'll see you in the next video.